Two is how have we hedged in the event that a downturn happens? And look, we're already seeing softening in the market, right? Prices are falling. People are making price cuts. There's less offers. Interest rates are rising. All of these things, people argue supply and demand. And we'll get to the arguments here in a second. But a couple of the hedges that we've made that are really unique to our business model versus traditional real estate or multifamily is a couple of things. First and foremost, all of our debt is 10 years or longer. Right. So we're not taking on balloon 311s or 5-1 arms. All of our debt is for at least fixed for the next 10 years. And just like you mentioned a lot on the history of real estate, if you look at the history of real estate over any 10-year period,
perfect.
Right. You know, if you can wait it out, you're going to be more than good to go.
Absolutely.
Right. And that's the important thing. In fact, if you look at 2008, right, over 90% of the loan defaults that happened in 2008 were balloon payments,
100%.
Right? That people could not actually make the payment on because, hey, when they woke up one day and they're like, hey, you owe us $500,000. And, you know, they're like, well, shit, I don't have it because it was bad timing in a bad place. And your backs were against the wall. And you're like, well, shit, take my house. Right. And that was the only option. So one thing we wanted to avoid is ever to be forced sellers for two reasons. Number one, the market, but also two, we're optimizing for cash flow, but we're also building a business that we believe we can sell this portfolio at a massive equity play in the future. But if we couldn't, you know, what's our downside? You know, at the very least, we're going to be printing money in a cash flow basis, right? So that to us was like, hey, you know, let's optimize for that first. You know, in terms of the market, right? In terms of the hedges that we're doing, we're also really experienced operators. I think experienced operators are incredibly important when it comes to a frothy market, right? How are we maximizing our team, our profitability? We talked about software a little bit earlier, right? Software means usually that you can run a leaner machine, right? Less salaries, less expenses, right? You can survive longer if you understand your runway. We're holding significantly more cash in reserves, right? For this exact reason. But we are seeing a lot of our investors actually investing more money more recently because they want to take advantage of the current buying opportunities that may be coming in the market, right? So here's what we do believe. We do believe that prices will soften. We do believe that we're decently well hedged, right? For us, we're across 8 states and multiple markets, right? So for us, you know, destination markets, city markets, you mentioned Arizona, we're in Scottsdale as an example, right? All of these, you know, Arizona and Phoenix specifically, right? You see supply today is almost as back to when it was 2019, right? And people are like, well, holy shit, should we be concerned, right? The short answer is no one really knows, right? And for us, we're also in a really great time because we're early in our fund, right? So if we're trying to exit right now, right, I would be concerned. Right. Because I'm like, I don't know what we can get today, but you know, we have a 4, 5, 6, and if we needed a 9-year runway to continue going, which historically the data shows you'll